say anything inappropriate. But second of all, I'd like to record, so if we had some peers that weren't able to attend and they wanted to review the class on their own accord, that they can do that. So welcome everybody to the, I call this a tax update workshop. And you may say, I'm just kind of following everybody here. I got the email from Tom and from Trevor, and I'm not sure why I'm supposed to be here, but I'm glad I'm here. And the reason why is because you guys are all at various points of ITC and have gone through and completed that part of the process, or it's in progress and completion. There is one more required class. It's actually listed as 3 hours on our website. It can take around that period of time. I'm anticipating we'll be here for just a couple of hours tonight, though, because that update is something that tax professionals take every year. They take 3 hours of tax update as part of their continuing education procedures to work here. You guys are no different because your class was taught to last year's tax theory. And so really, as you've learned that, you're now up to speed a little bit on last year's tax theory, but these are some of the changes to look out for. And what I want to establish is I'm going to go through this, we're going to go through this together, are some ground rules, which is I don't know everything off the top of my head, lock, stock, and barrel. A lot of it is brand new to me, and so we're getting accustomed to these rules, and I've now been through several classes that have explained them to me. But I don't have all the answers, but I have created a deck that hopefully makes it easier for you guys to understand, because I don't want you to get lost or confused or hung up on the details that come with some of the more advanced stuff, because this update is geared toward every tax pro. And if you just started, we found that most of our tax pros, they would dive in and it would be very detailed and you guys would get confused very quickly. We even had a couple of people say, I don't think I'm meant to be a tax professional. And so I opened up the update and I said, oh goodness, this isn't curriculum that I think first year tax pros would want to go through on their own. So you guys are here with me as your guide through this class that would normally be a self-study. And I have brought it to life and I've turned it into an in-person class. So that's why you're here, is that this is the final education requirement and I'm basically your final instructor. So God help you all, but I'm more than willing to help tonight. Okay? Any questions before I get rolling and start sharing my screen and make sure everybody can see the presentation? Hopefully you guys got the deck that I sent out earlier. You guys can keep that for your records and follow along at home. And I hope that that is helpful. So any questions before I dive in here?
I have a question, Austin.
Yes, ma'am.
Hi, my name is Christina Albright, and
Okay.
Just starting with you guys this year.
Mm-hmm.
Is this class that you're leading us through in place of doing the training online, or do we also have to go then do the training online to click through it? And
you can, and I thank you for reminding me, because in place of this training, you guys are welcome to skip to the back of the module and proceed. Everyone will have to complete the assessment. Where I've gone ahead and I've gone through the assessment yesterday so that I know that this class is a good baseline as a substitute. So you guys are more than welcome. I will show everybody how you can actually skip through the online module if you choose to. You don't have to do it over again, and then go proceed straight into the assessment off the curriculum and slides I've provided. So I've left a lot of Easter eggs in my slides to help, but I don't want to give out answers. Obviously, that's against our ethic protocol and things like that. But my deck has a lot of the stuff you guys need to know for the assessment. It's 20 questions. It does mix and match those questions. You may get different questions, but it's just the assessment that would be required. I will show you how to get through this.
great, thank you so much.
You bet. And I got a question in the chat here, and I will do my best to keep an eye on the chat as well. I don't actually think that was this chat. We're dual, I call it dual wielding classes tonight. The experienced people have a class from 6 to 7:30 as part of their skills to win training. Tom did want me to touch base with you guys so that part was at least a little bit clear to you. This class tonight is not paid. It's just another continuing education requirement. And that's why this session is totally 100% optional. You do not have to attend any of these sessions because it is unpaid. It's just for your benefit. There is paid training, though, when it comes to our skills to win training. And I think, why don't I share my screen here so that you guys can see where you would find that. And so I'll come in here to DNA. and I will sign into my account here. And I'll head into Block Academy so everybody can follow along with where I am. And now I'm not going to be able to pull up you guys' exact training path because it looks different. But if you come in here, if you haven't started your skills training at all, you're almost kind of ahead of the game because your skills training would be right here in your assigned training. If you haven't picked it up yet, it'll be right here in assigned training, and all you have to do is click an add button that will be right here, and you can add part 1 into your basket. Excuse me, I call it a basket. It's actually called your transcript officially. And how you get there to your transcript, which is kind of the living, breathing organism of your Block Academy profile, is right here. And if you click add, it will show up in your transcript here, and it will look very similar to how mine looks here, because it'll also say TS21, that stands for Tax Season 21, SAS, but instead of prior, because I've been with H&R Block before, it'll be new, Tax Professional, and then you guys are starting part 1. I've been at training since October, so I am on part 3 already as well. And this is what all of our Skills to Win training curriculums look like. You would click on Open Curriculum, and you can see some of the stuff that I'm going through about leading office experience and things like that, but your training is detailed to you. How, and I can certainly share this out, but I think Trevor may have sent it out approximately 1 billion times, is that you guys also have a passport that tells you to make sure you're in the right spot here. And if you wanted to search for this exact phrase here, that would take you to this spot. But you guys can probably guess from looking at this where you'll want to head to, which is First Year Tax Professional Passport here. And I would assume searching this in DNA would provide the same results, but I'm more than happy to share this out with everyone in attendance. These are the classes that are included in part 1, and this has actually been ready for release since November 9th. But some of you guys have different start dates and stuff relating to your classes. I know it can be a little confusing, but ultimately that's to make it not super confusing about where to access your class or where it went or whose account are you supposed to sign into and things like that. So hopefully you guys are working through your Skills to Win training. This is your paid training. You clock in from home. I think Tom went through clocking in on the orientation. If everybody had gone through the orientation class with him, I was on that call. I think it was last Monday was one of them. There may have been one on Wednesday as well. So if you'd gone through the orientation, hopefully he showed you how to punch in. This is paid training that you guys hopefully are working through. Once again, my email box is wide open if you have any questions about what you're supposed to be doing, because if you're engaged, I'm ready to help because I can point you in the right direction. This technology even allows us, I can look at what you're looking at home and point you in the right direction. So in some ways, it's much more powerful than even when I had Trevor's old job. And I've walked plenty of first-year tax pros through the process, and I'm glad we have all these tools. So any questions on Skills to Win before I move forward? Because Tom wanted me to touch base on that.
Austin, I've got a question that
Sure.
Some of the courses further down the page there don't seem to show up on the search.
So are you talking about these
the
two
tax
down
interview,
here? Okay.
Support during and beyond the tax appointment. I couldn't find them.
What I would say, are you all the way through these guys here?
Well, I think there's one other in there that I couldn't find, but I don't remember off the top of my head.
Yeah, hopefully what I talked about with coming into your homepage and clicking add here, this is the way I recommend to do it. It may still be there if you haven't actually claimed your training, and no, you're not going to have to do anything over again. It will just look at which classes you've completed individually, and
Okay.
some of them are buried within the course module here. So you won't be able to find them in the search bar. For instance, if I searched for this one right here, I would not find this course in the search bar because actually it's just buried inside of Inkling. So a few of them are not available to just find through the global search, and you'll want to look inside the curriculum.
Okay, so just wait until it shows up in that Block Academy block.
Yeah, the assigned training, that will point you in the right direction. In fact, if you haven't touched anything based on the passport, part 1 and part 2, because it was scheduled for release here on the 7th of December, both of those should be now showing up as parts 1 and 2 in your assigned training if you haven't pulled them in yet. I bet some of you guys have actually already gone through and completed if once you saw it, but we can certainly screen share on an individual basis to look at that and see where we can find your training.
Okay, thank you.
Yeah, I say that because sometimes I even just have to contact Block Academy support and they have to manually put it in for you. So yeah, every once in a while, tech doesn't always work in our favor. Okay, perfect. Any other questions on skills before I kind of dive into the update course? Perfect. So you can always feel free, by the way, this functionality that you might see in the participants list here, you can raise your hand if you do have a question, and then I have a couple of baked in question spots as well. You can certainly use chat, and I will bring that to my attention if I see the chat questions as well. Good way to keep it moving, and I'll keep an eye on it. So I'll go ahead and close this down and pop this guy open. And so I will begin kind of in earnest. I think I actually want to do it this way, just so that we don't have my little search bar. There we go. So you guys can see the whole screen and make it as big as possible. So I want to make sure you guys can read the content. What I recommend is not copy pasting, and what I mean by that is frantically taking a pen and paper and trying to write down everything on the slide because I shared the deck out. What I recommend is jotting down key concepts, things that register well with you because of an explanation where I may phrase it a certain way and they're like, oh, that makes a lot of sense. What I don't want you to write down are exact tax figures and tables and things like that that are available both on the deck and inside the course. And to be quite honest with you guys, I never really memorize any of that stuff because it changes every single year. You can always refer back to the curriculum if you get an exact question about what's the filing status requirement with this. And I know I'm probably regurgitating what you've already been through and done that with ITC, but just a helpful tip from me. If you guys don't know me, my name is Austin Swaim, and I've held just about every field title that you could hold under your belt. I've been client service professional, moved up to a tax professional. I was an office manager back when that role existed, as well as I've been a multi-unit team leader now for 2 years. I manage our district office. So that's up at I live in 225, and it's the largest of our 25 offices, and it does almost $1 million in revenue. So certainly one of the biggest offices up there. I have a lot of experienced credentials, tax professionals that really take care of clients much more so than I at the office, as well as I have Tiffany Plaza, which is out at Hamden and Tamarack, and Hamden and Tower. And Hamden and Tower is my one location with my first year, which is Luna Pavaro. She's on the call tonight, and thank you, Luna, for attending. And just like all of your multi-unit leaders are, I'm very excited to have a new member of the team joining, and I want to be there for you. I want you to feel like I'm a resource, that your multi-unit leaders are a resource, and you feel supported and you feel good, because it's going to be an interesting experience, I'm sure, from time to time, because this job is unlike any job you've taken before in your entire life, and I guarantee that. So welcome, everybody. That's who I am. I certainly am excited to try my skills tonight, because being an instructor, just like many of you went through, is one of my goals for the upcoming summers and things like that, as I continue to get more experience under my belt. So I will get started here. You're going to see that a lot of times I cut and paste right from the course curriculum, because it's actually something that's very easy to understand and helpful. This tax update is confined into 7 modules inside of that self-study course. If you've already been through the course, you kind of know what I'm talking about, but these are the 7 categories we'll be going through. Revised form changes for 2020, direct COVID-19 changes. There are plenty of those, and kind of made this update really unique from some of the other one. Some changes to education and retirement rules, disasters and net operating losses, exclusions, deductions, and credits, some identity theft updates. That section's very small, and then some inflation adjustments. Like I said, every single year they change things like filing statuses, standard deductions, or filing requirements, standard deductions, all that good stuff. So yes, just right when you guys learned what it was supposed to be and got all that stuff down, they went ahead and changed it. So you'll have to get adjusted to it. The good news about that entire section, as I'll talk about when we get there, Blockworks really calculates all of that for you as you continue to work on doing taxes. So you don't have to spend a lot of time logistically there, but still nice to know, and some tidbits that I have baked in there. And things we'll cover. I don't have everything from the course in here. I have number one, what's relevant, and number two, what's possible for you to understand, because there are some changes that are outside the scope of this course for a reason. There are things that are not covered on the assessment, as well as there are things that, as a first-year tax pro, I don't even want to have to begin to you how the old rules worked in place of the new ones. So we'll go through this together, and I think you guys will get a heap of content out of it. So I'll start in with some revisions to forms, because since the Tax Cuts and Jobs Act went through in late 2017, a lot of the tax forms have been changing, as we know that. I'm sure you guys have been seeing that on your own personal accord, as well as through ITC. Things have been a little different, and so I wanted to just explain some of the changes that were covered in the course. So it started right with where you should start, which is the Form 1040 page 1. And it highlighted the changes on the 1040 page 1. So there are really three big changes on the first page. The first, highlighted right here, is there is now a bold-faced question about receiving, selling, sending, exchanging, or otherwise acquiring any financial interest in virtual currency, things like Bitcoin. This is a very hot topic for the Internal Revenue Service, because it's a very hard to track concept of people selling and trading internet currency. It's something that you can always change the location of where you are on the internet, which makes it inherently difficult to tell where money and value is flowing. And it's probably one of the larger sources of current modern tax fraud because of how much ambiguity there is about it. And so this question is probably designed so that taxpayers know that it is taxable. If you check yes on that box, they are looking for taxable income reported somewhere on the return. I couldn't actually tell you where the best place to report that virtual currency is. It kind of depends on the nature of the currency and how it was acquired and all sorts of stuff like that, but that's mostly to bring awareness to it. They renumbered the retirement income lines, which is, I didn't even remember what they were renumbered before, but they are on different line numbers now. And the biggest thing I think that you'll find on page 1 is the above the line charity contributions. Now people can write off up to $300 without even getting towards standard or itemized deductions. That was put in through the CARES Act, and as you guys can probably guess, it was to incentivize people to donate toward COVID relief efforts in 2020. So now somebody like me who takes the standard deduction can go ahead and deduct $300 above the line, similar to where you'd see student loan interest and things like that. That is right now smack dab on the 1040 for people to see.
Does it have to be COVID related?
No, it does not have to be COVID related. We'll get into charity contribution changes in a second. It does not have to be COVID-19 related. It can be any qualified 50% charity, but we'll get to that. We'll get to that in detail as it goes through. This course kind of works like an onion, where it started on the surface level and then they just kept peeling it back and back further. So you'll get a lot of your questions answered as they go through. So which is nice. On the back here of the 1040, some of the changes from what you guys may have seen, I really like this change, is that federal income tax is now broken down by the source. So if you have a Form W-2, Form 1099, and other forms, I think for us as tax preparers, that's very helpful to see where we're getting our tax from. Blockworks for years has generated a form that told you where tax withholding was coming from and which forms. Now it'll be right in the middle of our workflow if you're checking out the 1040 to see what it looks like. Line 26 is now scheduled for estimated payments. Before, this was on Schedule 3 and it kind of got buried in those supporting schedules. Now there's a line right away to make sure that you've got the estimated payments. If you have somebody that pays quarterly to the federal government, that can be reported on line 26 now, and it's in plain sight. Line 30, the recovery rebate credit. Whoops, sorry about that, guys. The recovery rebate credit, the keyword there is stimulus. And so this has to do with the economic impact payments, the $1,200 that were sent out to a lot of Americans. There will be instructions about how to report this credit. I'll deep dive it later in the course and what the protocol is around using that line to claim that. That is a refundable credit. So it works just like earned income credit or additional child tax credit, that it can actually end up in the hands of taxpayers. And I really, really would have liked to know this about at this point 8 months ago when they were first coming out in April, so I could tell people not to panic if they didn't get the full amount that the news said that they were entitled to. But it is indeed there on line 30. And then line 37 here, it didn't really change as much as there is wording. Schedule SC filers line 37 may not represent all of the taxes you owe for 2020. That is worded toward the payroll tax deferral rules that went in. I will deep dive that because it can be a very confusing concept if you're brand new to tax or don't have any payroll experience about what that looks like as far as one of the benefits of some of the COVID-19 procedures. This by far is one of the coolest changes that they've made in this entire workshop. It's not hard to understand, but 1040X returns, which are amendments, it's something we do quite often here at H&R Block. They are now available for electronic file, which helps a great deal because before the protocol for an amendment was you would send it in, you'd wait 4 to 6 weeks, you'd be tapping your toes, and then they would send a letter back saying we need additional information. You'd send the additional information, they say, well, we need it packaged all together. And so it could take years, plural, to finalize an amended return if it wasn't done 100% correctly through the process. Now it's as simple as you send the amendment electronically. And it's not perfect yet. You only do get one amendment sent electronically, but some of them are very simple and very quick. It's less than an hour in and out to get an amended tax return filed electronically. And this has been very helpful because the IRS has been behind much of 2020 with their paper processing. So things that have been sent by paper or even by fax have a longer response time than expected. Obviously, they are short-staffed and have lived through some of the COVID stuff that all of us have lived through, as well as they have plenty of questions about that $1,200 stimulus check, as I'm sure you'd imagine. So those guys are now available for e-file. That's something they've been working on for years, but COVID finally had us push it out even before it's at its full capability. But very exciting that has developed. So this will be, it's not a new form. It existed last back in 1981. We've seen non-employee compensation reported on a 1099 miscellaneous form. So the 1099 miscellaneous has all sorts of different boxes that it could be categorized, but the most common one is box 7, which was non-employee compensation, and that's how a lot of contractors got paid that were not official employees of the company. This form has been reintroduced for 2020. I'm actually not sure. That's a 2021 edition. It may have been introduced this year and then it's officially released for publish come 2021. Either way, it's back in the tax news because this form will now exist to satisfy that purpose. And what that means is that inside box 1 now this will be on its own form for contractors, and it must be filed with an employee just like a 1099 box 7 if they earn more than $600 as a contractor. I think this is exciting because when you receive this form, it's a lot easier for clients to understand what they're getting. It's a lot easier for us as tax pros to not be tempted to put it on the wrong spot on the tax return, because if you get one of these forms, guys, we're going to have to file a Schedule C because that person is technically self-employed. And I think it just clears up a lot of the confusion around that. Why is that so important? Because every time you order food to your house or you get in the back of an Uber on your way downtown, those people that are doing that service, they're getting paid on a 1099 miscellaneous currently. That will transition to this form. I actually don't know if the curriculum was talking about 2020 or 2021. Given this was the form in the curriculum, they may not have been able to do a quick enough turnaround for 2020. It'll be 2021 when this form makes its official return. So Form 7202 is the one that I want to draw you guys' attention to. This is a very high-level overview because a lot of these rules and regulations have to do with businesses, but this form is essentially for self-employed people to claim the CARES Act credits available to them. because they don't file quarterly tax. Oh, that's a typo there. It shouldn't say credits. They don't file quarterly tax returns like a larger business would. Larger businesses are required to file a Form 940, which is a quarterly tax return every quarter, and that is how they claimed all of the CARES related benefits. This form was created for self-employed people who don't do that. And so there's credits for sick leave, there's credits for family leave. We'll dive into those CARES coronavirus relief credits later in this course at a high level. So just this is what the course wanted you to be aware. This form now exists. You guys all love those questions on ITC midterms or finals about what does Form 7202 do? And you can Google it really fast and figure it out. But that's just for your information. Okay, so the Form 1040 NR makeover, again, this is high-level material compared to what first-year tax pros will get, but a 1040 NR, if you're unaware, is a non-resident tax return. It was very strange that we were still filing this form that looked like it's 2017, brother. And now it's been updated to look more like the current tax forms as we know them. And that includes the additional schedules 1, 2, 3, and A. So it's really just more in line with what the normal 1040 or 1040 SR looks like. The 1040 NR EZ form, just like the other EZ forms were canned in 2018, has now since been canned. If one of you guys is ever in a position where you're doing a non-resident return, please ask for help, because I'm not even very comfortable doing non-resident returns, and I've been here for 5 years. You just want to make sure you get it right as well, because there's immigration status, ramifications. We definitely want to get it in the hands of an expert. But just for your visibility, the form's been changed for 2020. So some other miscellaneous changes, and I'd say hint on this slide just in case you do get one of the Easter egg questions here. Several IRS publications are now available in up to 20 different languages, and you can actually use now it's actually called Schedule LEP, not Form LEP. I make that mistake quite frequently, but Schedule LEP can change a taxpayer's preferred language of communication with the IRS. And why that may come into play is if you get a tax client who primarily speaks Spanish and they'd prefer to receive any potential letters or audits in Spanish, the IRS can accommodate that request by filing this form now. And I think that's a very progressive and helpful change for a lot of people that file their tax return with the Internal Revenue Service. The other change here is that Form 8915E is likely to be the 2020 version. That we've gotten a different form of this type every single year. So Form 8915A was all the way back in 2016, and it's gone A, B, C, D, E now here in 2020. And this relates to the casualty loss changes and provisions back to 2016 in the Tax Cuts and Jobs Act. So we'll dive into casualty losses at a really high level overview later, but that's just kind of a form change to be aware of. So I guess I could open up quickly for questions. Any questions on Module 1, which is form changes? Cool. Is this pace working well for everybody? Am I going too fast? Is anybody lost?
This is good.
This is good.
That's good.
It's good. Austin, I think you're muted.
Is that better?
Yes.
Hello?
Yes.
Cool. Perfect. Sorry. All right. I was trying to switch back to chat and I muted myself, so that's very, very hands-on there. Let's take a look here. Okay. So this is one of the most important parts of the COVID-19 changes of the update, because this is the stuff that's really strange compared. We're moving around. I like to call it rearranging your living room furniture instead of actually buying new furniture and making over the living room. You're just kind of moving things around. These are pretty substantial changes related to COVID-19 in a lot of different areas. And it's kind of complicated, I think, as you go through. Thankfully, this update did not go through a lot of the changes for businesses. If you're interested in business tax, you may have heard key buzz phrases on the news like PPP loan, or family or payroll retention credit and things like that for businesses. That was very helpful for them to stay provided and afloat. This course thankfully really covers more of the individual impact, which is good. So there were some changes in 2020 that were historical. They changed our business model quite a bit in that the IRS back in April extended the tax filing deadline and deadline to file an extension on a 2019 return through July 15th, 2020. And this was available to all of these entities here. It was individuals that filed a 2016 return for a refund, because if you remember from class, you have 3 years to claim a refund in a particular year before the IRS says can't let you claim it anymore. That deadline was extended to July, as was filing your 2019 individual return. That's what all of those forms are there. Estates and trusts, C corporations, S corporations, partnerships, and nonprofits. So all of these entities saw a delay from their normal March or April 15 deadlines and said, you know what, if you didn't get it in, you are good. Our new deadline is on July 15th. It was very, very strange to be working on deadline day and it was almost 100 degrees outside. But it was so on and so forth. We're moving through July this year. And some other changes to July as well. You have a deadline with a retirement account like a traditional IRA where you can actually report a deduction on your tax return even if you didn't make the deduction yet, as long as you contribute to that retirement account by usually April 15th. That deadline, just like the deadline to file that return, was extended to July 15th. The HSA contribution deadline, so that you could use the HSA deduction, was extended to July 15th. And the first 2 estimated payments of 2020 were extended to July 15th. So if you pay quarterly, normally you would pay one payment in April and another one on June 30th. Both of those were pushed back a little bit to July 15th to help people accommodate getting used to living in this new world we were in. So the first one I want to dive into is this payroll tax deferral, because this can be a little bit confusing if you're reading it at first glance. And really, what this means in plain English is that there are 2 components to payroll tax for somebody who is self-employed. And so that means they come to H&R Block and they file a Schedule C. They pay self-employment tax. And it's 15.3% of 92.3%, whatever that magic formula is there. Half of it is comprised of what would normally be an employer's share of their payroll tax, and half of it is the part that we pay in. I work for H&R Block. I get paid on a W-2. Out of every single one of my paychecks, they take out FICA tax. They take Medicare and Social Security. It covers my expenses for those because I'm an employee of the company. H&R Block is actually, if they choose to, able to defer their payment on my payroll tax if they want this year. And this is a break for businesses that self-employed individuals get to take as well. The employer share only. They still have to send the IRS the tax that I have put away, or the tax that they have put away as self-employed individuals, because there are 2 halves to self-employment tax. The first half is the employer part. The second half is the employee part. So that can be kind of confusing that you pay 1% of tax on this one line on your tax return, but it's actually kind of 2 parts. It's because you're self-employed, you are the business owner, and you are the employee. It's very strange. So roughly about half of your payroll tax is eligible for these people to defer. And it doesn't mean it goes away, which is something that is very important to tell some clients if you are interested in leveling up to help small business clients. I want to make sure they know it doesn't go away. They just can pay 50% of the 2020 balance due by 12/31/2021, and whatever they did not pay in 2021 is due at the end of 2022. So this is shifting the burden of that payroll tax for employers and kind of kicking the can down the road, if you want to look at it from that syllabus amount, because it's not gone away, but it is a way that you can defer that expense, because a lot of businesses right now are hurting on the revenue side. They're not able to operate at full functionality. The government says, you know what, on your part of the tax, you can wait. If you choose to wait, you don't have to, but you certainly can. A second part of this was signed in as a presidential executive order in August, which deferred 6.2% of Social Security tax to January through April 2021. And I don't want to get into any of the politics or philosophy behind that, but it is a mandatory deferral. So basically, they're not collecting Social Security tax currently that you had to opt out of if you chose to. And a lot of government organizations like the military and things like that were not eligible to opt out of that rule. Kind of confusing, but what they're saying is, listen, right now you should not be paying half of your payroll tax. You shouldn't be paying your Social Security tax. You should be paying your rent. You should be paying your employees to stay on your payroll and make a living. Do it at some other time down the road in the next couple of years when we start to rebound from this. So this, yeah, go ahead.
Said that last part of the executive order, does that apply to self-employed people as well then?
That part does not apply to self-employed people because that's people collecting FICA tax only.
Okay, thanks.
Okay, so really the payroll tax deferral option, how that's calculated for a self-employed person is right there on that form that I just changed to a Schedule SE, and it will tell them how much they are eligible to defer on this year's 2020 edition.
Okay.
And that was the disclaimer on line 2 of the tax return, is because it tells you, it says straight that you may owe more for 2020 than this. See Schedule SE for details. That is Schedule SE that calculates the amount that they're going to be eligible to defer to the next couple of years. So there are a couple of other changes to this form. If you weren't very familiar with it before, this may not resonate well, but there's no longer an option for just a quick calculation. You have to go through the entire Part 1 self-form explanation here. And that means, of course, there's an optional farm method that you can go through. There's another optional method there. You kind of have to go through the whole worksheet now. You can guess by my lack of conviction in that Blockworks does go through that for us. I haven't filled a Schedule SE out by hand since I was in tax class long ago. So the part three now here is established. It's not shown on this form because, as you can see, the watermark, it's draft as of August 10th. It hasn't been fully released yet with part 3, but there will be a section for deferral on payroll taxes. So in short, we're kicking the can down the road on some of these self-employment tax expenses for our people that are Schedule C owners, which is going to be very helpful because some people may have picked up Uber or Grubhub or DoorDash and not realize that they're now a self-employed contractor. And that can really spook people paying self-employment tax in the first year. At least now, if they choose to, they can defer some of that expense out later. That's not really the design behind it, is so that if you don't know you're a business, to kind of kick the can down the road, but it's something that our clients will have the option to do. I want to talk about this as well, and you'll probably guess that I'm not much of an expert. I probably spent the most time reading and preparing for this section, but the Families First Coronavirus Response Act, FFCRA, and medical leave, it essentially expanded the Family and Medical Leave Act to include a public health emergency leave, which is very appropriate for what COVID-19 represents. And this covers businesses with 1 or more employees. That is not the business owner, but people with less than 50 employees can apply for a hardship exception from having to provide this medical leave by law. They are required to give paid sick leave to an employee. And I'm going to kind of go step by step here because they must have been an employee for 30 plus days, or if they were laid off because there were some surprise and emergency layoffs as a result of COVID-19, at least employed for 30 of 60 days before a potential layoff. And these qualified employees that are eligible for this leave program through the end of this year must be connected to COVID-19 circumstances. So that includes the employee being ill or subjected to quarantine. That's not supposed to be suggested. Caring for someone who is ill or subjected to quarantine, or caring for a child under 18 whose educational facility or daycare is closed due to COVID-19 circumstances. And so there was certainly a lot more of that in March as things were kind of shutting down, but it is still an option for somebody to become a qualified employee under this provision. So the payment amounts and limits are as followed. For sick individuals, so people that have been diagnosed with COVID-19, or they technically throw in people that are subjected to a forced quarantine because the employer doesn't want you coming in, and H&R Block is just the same, that you're subject to this amount of leave here if you are subject to a quarantine that we are forcing you to take. So it's up to 2 weeks, which is up to 80 hours of pay at 100% of their normal rate, but that is at a maximum of 511 per day. For people who are caring for sick, or you have childcare options closed, so that you're not directly sick or forced to quarantine for yourself, it's to aid a direct family member to take care of somebody. It is 2 weeks at 66.7%. That's 2/3% of their normal rate, and it's a maximum of 200 per day. So it's knocked down a little bit if you're not actually sick or directed to quarantine yourself. And there is paid family leave as well. But here you can see 12 weeks of family leave related to these components. It's at 66.7% rate of pay, max $200 per day. And generally the first 2 weeks of this cycle is unpaid, but you can substitute 10 days of sick leave if possible. All of these, and H&R Block has their plan for associates to get paid through this program, as well as really all the large corporations and anybody we might run into would, is reported on your W-2. If they went through a third party, it could be a code J, which is third party sick pay, but a lot of times it may just be hidden in box 1, and we just never even are able to tell the difference from normal pay amounts as a result of this program. So as you could probably guess, just like I talked about, self-employed individuals, it's a little different because you can't have your employer pay you sick leave, but you're still sick. And so it's the same provisions of being diagnosed with COVID-19 or directed to quarantine because of direct exposure. You can get up to 50 days of sick pay if you fit one of those parameters, and it's at the smaller of the average self-employment rate of their income. So it's your total income for the year divided by 260 days. That's just what the IRS uses for how many approximate days out of the year somebody's working versus not working, or 511 per day. You get the smaller of that. So people that make less than 511 on average with that formula receive just what their normal rate is. Otherwise, you're capped at 511 per day. Same provisions as before with the caring for sick people or child care closed individuals. You get up to 50 days, and it is at the smaller of 2/3 of your annual rate, or $200 per day. If the self-employed individual has employees, that's beyond the scope of this course because it actually requires payment in 2 different sections. So that would be somebody who's on a Schedule C with W-2 employees. That's a very, very rare circumstance, and not one that I want to waste time having to come in and explain to everybody, because I'm not even sure I could. But certainly not necessary for kind of understanding the benefits of that sick leave program. The course module, as well as I want to talk about unemployment benefits, because as a fresh reminder, it doesn't maybe get talked about a ton in ITC because it's just like kind of that one of those other income categories, but they are taxable and unearned income, so they don't contribute towards your EIC formula. The CARES Act expanded this bonus of a bonus $600 per week of unemployment, as well as boosted the overall maximum weeks you could collect to 39 weeks. This bonus program ended on July 31st, 2020, but that still has impacted people in that they are receiving much more in unemployment. And what I put there on the final line is very important, that many clients choose not to withhold taxes out of unemployment. So rather, I want to get somebody involved here that may have an idea, but what's a problem that if somebody comes in and they haven't been withholding tax out of their unemployment, what potential problem could that create for somebody who you're filing a tax return for? And introduce yourself. Hello?
They could owe a lot of money that they don't have saved.
Right. Let me see. That's Miss Christina again. And so, yeah, absolutely right. Really one of the largest problems is, what if somebody had been working through about the middle of March or so, they got laid off from their job and was collecting unemployment until the program ended on July 31st, and then they returned to work. Say that person made $50,000 in wages this year and then collected another $15,000 in unemployment and didn't take any tax out. What are some of the problems that could be presented for us? Well, they have all of this additional income, but they haven't put any additional tax away. And that's something we call in the business here, we call it refund surprise. And that's where a client comes in expecting one outcome on their tax return and gets something very different. And I don't wish your first refund surprise on you, but it is going to happen because it just happens occasionally where somebody just is expecting a totally different outcome and they're kind of shocked by either a much lower refund or a balance due when they usually get a refund, and it can create a really uncomfortable situation for the client. So that's just something that you guys should be aware of, is that you may run into. It's not hard to code unemployment benefits as a tax pro with H&R Block. You just enter it just like you would a W-2 through our 1099-G screen, but it can have a big impact on somebody's tax outcome. And so we're hoping to see enough taxes withheld from our clients that do have unemployment, and being able to explain the benefits if they didn't, if their refund's a little bit less than they were expecting, maybe it's because of the unemployment benefits they got.
So they're going to charge like additional like penalty or something if they don't pay?
Well, think of it this way. What if I took up a second job and I earned $15,000 additional in wages, and I chose not, and I claimed myself exempt from having to pay tax? I would move into a higher tax bracket because I'm earning more income, and I don't have anything put away to offset that. And so it's not really a penalty as much as the general fundamental tax equation of I earned more money and I didn't put anything away to pay for the tax I'm expecting on it.
Okay.
Does that make sense?
Yeah. Yes.
Yeah. So in essence, it's a self-imposed penalty, but you certainly don't want to make the client feel bad about it, because they're probably generally unaware that some of them are genuinely unaware that unemployment benefits are taxable because it comes from the government. Why would the government take money from money I got from the government? It doesn't make sense to a lot of people. You could argue about the philosophy of it all day, but you do want to help ease clients into that if they hit that refund surprise outcome. So some additional CARES Act benefits,
like so they're going to pay like self-employed at the end of the day, I think so. Yeah.
If they do not pay self-employed tax on unemployment benefits, so self-employment tax is only paid on income earned through their Schedule C business, and usually that's reported on a 1099 miscellaneous. Okay.
Yeah. Nice.
So just some other benefits introduced by the CARES Act. I love the random stuff that gets thrown in these large scale tax acts and relief efforts, because now unreimbursed medical expenses now include over-the-counter treatments and medications, things like antacids, cold and flu relief, things like that. That now qualifies as an unreimbursed medical expense as far as something you can use from your HSA. So if you pull out of your HSA, you use it to buy Tums, it's now eligible to be treated, as well as any menstrual care products as well, the purchase after January 1st, 2020. So you can write both of those expenses now off. It's something that clients will like, because a lot of times they will bring in receipts from like Walgreens and talk about vitamins and all sorts of things like that. They're now actually qualified unreimbursed medical expenses, so that helps shelter some tax on money coming out of your HSA. So any general questions? That was very high level as far as the course module only went through the individual effects of the CARES Act changes. So hopefully it was decently straightforward. Does anyone have any questions on that module? Perfect. So now we'll move into the education and retirement changes section. There are some CARES Act provisions that are baked inside of this that specifically have to do with retirement changes, some education law changes as well. So as I'm sure many of you know, I personally, because I am only 25, so I do still have student loan debt that I'm paying off from my degree from CU Boulder. So sorry to the Ram contingent out there, but go Buffs. And these provisions were put into place on March 27th as a result of the COVID stuff, and it was certainly helpful as we were all trying to get by in that time, that they've ceased the active student loan payment collection, and so you no longer federal student loans only were eligible to be paid on. Any default or past due student loans were pulled out of collection, and the interest rate on federal student loans is now 0%. And so this was provided that there were a lot of people that were forced out of work due to COVID-19. No longer did student loans become feasible to pay. The government put a giant freeze on student loans. It also incentivized a $5,250 tax-free payment of student loans by employers. So if your employer went out of your way to pay student loans on your behalf, they can actually take a tax credit at that level. These provisions run through December 31st, 2020. We don't have any word of an extension or any sort of rules or regulations around what's going to happen after December 31st, 2020. It very well could be business back to normal come January 1st, but this is something to keep in mind because what we're going to see less of this year are student loan interest payments, because if payments have been frozen and people have chosen to not pay them, then they won't receive a 1098-E for student loan interest, as well as I've been making some payments on my student loans, but I'm not really paying off active interest. It's really just principal that I'm applying mine to. I don't know if others are making the same decision, but we should see the volume of student loan forms down because of these provisions. There were some changes to 529 plans, which are qualified tuition programs, and now you are eligible expenses to pull out of these programs, which again, if you're not sure what they are, a high level overview of them is that they are tax advantageous shelters for education funds that when they come out of the fund and are used on qualified education expenses, the post-tax benefits are non-taxable. And so it's a good play. It's one of the very few places that you can store money and earn interest and pull it back out without having to pay tax on anything besides the interest. This is one of those programs. It's kind of like an HSA for education benefits. You can now pull expense and spend on expenses for qualified apprenticeship programs. That includes any books, fees, materials, and equipment related to the apprenticeship program. I couldn't tell you offhand what an apprenticeship program necessarily was. I believe it's talking about if you're going into a skill or a trade. I would have liked to sign up for one if I could have become a baker or something, but I didn't know we were still doing qualified apprenticeship programs. But if you are, you can pull expenses out of your 529 plan and use them so you don't have to pay tax. As well as you have a lifetime maximum now of $10,000, and you can withdraw it out of a 529 plan to pay student loans. The interest that you pay on your student loans when using this method is not deductible, and that's just so you don't double dip in tax benefits where all of a sudden you're paying off tax, you're getting a tax-free distribution from an account and you're deducting the interest for a double whammy on money that you're not paying tax on. So you can't really do both, but you can withdraw $10,000 per designated beneficiary, and that may be important if you get a client who has multiple children on the same 529 plan, multiple beneficiaries. It's $10,000 per individual and designated beneficiaries that you can pull out. This is a lifetime maximum, $10,000 to pay off student loans. So that's just a provision that's put in place. It makes sense to me that it's just education expenses after the fact instead of before the fact. So overall, I think a positive change is something that if our clients mention, I'm really kind of buried underneath my student loan debt. Well, do you or your parents have a 529 plan? Just another something little wrinkle we might be able to toss in here or there if we get the right opportunity. So the tuition and fees deduction, you guys may have zero idea what it is because you learned taxes in 2019, but this is one of the options for how you could deduct higher education expenses. You probably learned about the American Opportunity Credit, the Lifetime Learning Credit. This used to exist back in 2017, and it's been gone for a while, but it is returning in 2020, and it expires again at the end of 2020, and you can amend prior year returns that might qualify if it's more advantageous. And really, I think the one reason why you might do that is because it's not advantageous, but maybe you claimed American Opportunity Credit in a year. Remember, you only get 4 years you get to do that. You might be in a situation where you say, you know what, it was close enough that I'll pay a little extra tax by only taking the tuition and fees deduction that year, and I'll save one of my American Opportunity Credit years for later if I need to. But either way, this is eligible for 2020. Here are some of the parameters. They are fairly identical to what it used to be, but there's a $4,000 maximum deduction of tuition and fees. There is a maximum AGI eligibility requirement. So if you make over $80,000 and you're single or head of household, or $160,000 for married couples, you cannot use the tuition and fees deduction. It's claimed on Schedule 1 after using Form 8917. All higher education benefits are eligible, so it's not as picky about what type of university and things like that. There is no maximum years that you can use this, as well as tuition, fees, books, and other qualified expenses, really just anything besides room and board. That's very similar to the American Opportunity Credit. But however, you can have a felony drug conviction, American Opportunity Credit. You can't have one of those on your record and still use. And it can be any degree, coursework, or enrollment status. You can be below half-time and still use this deduction. So it gives us another option, does a lot of the things the lifetime learning credit does. But hey, as a tax preparer, I like options, and you guys bet that Blockworks really has an optimization tool to tell you which one is the best. Since you can only use one, you can use the American Opportunity Credit, you can use the lifetime learning credit, or you can use the tuition and fees deduction. Blockworks tells you which one is the best one as far as using their outcome. And it's even smart enough to say if it's close, save one of your American Opportunity Credit years for when you might use it. Okay, I need to take a deep breath because we got a big boy coming up here, which is the Secure Act that went through. This really was before the COVID stuff that we got set up. They weren't really anticipating a global pandemic in 2020. But this was already enacted, and it was setting every community up for Retirement Act, the Secure Act. And it was really just a few miscellaneous changes that were welcoming as far as easing burden on Americans that are retiring. And it was very small miscellaneous changes, like it changed the date for required minimum distributions to start. Instead of it starting at 70 and a half, it has now been raised to 72. I'm in favor of that just so I don't have to count half birthdays and kind of figure out where that went anymore. Now it's right when you turn 72, so it's your birthday. There's no ambiguity or calculation behind it. There's no longer a maximum age to contribute to traditional IRA accounts. It was 70 and a half. Now there is no limit. As you're putting into a traditional IRA and if you're over 72 and being forced to take out of your IRA, you could just put some in. I suppose you could deduct it, but it's only going to make your required minimum distribution higher in future years. It doesn't make much sense, but I'm just glad it's not a provision that we have to worry about. The fewer rules, I'm sure, as you guys know, the better. Another important stipulation was that part-time employees working 500 or more hours in 3 straight years are now eligible for a company's 401k plan. That's of importance to you guys if you're H&R Block seasonal tax preparers. A lot of our tax preparers work 500 years in January through April 15th, and then they spend the summers and the winters with their grandkids or off spending time traveling or whatever you might to do. Now you'll be still eligible to enroll in the 401k plan at a company. Right now, it's 1,000 hours in a given year. That provision is now changed to 500 plus in 3 straight years. That's to recognize seasonal employees just like you guys. So that's really fun and cool. Postgraduate tuition paid now is included in compensation consideration for IRAs. So when it comes to determining limits of how much you can contribute, they now postgraduate tuition used to be something you could deduct out of that amount. It now stays in. Foster care, difficulty of care payments are now eligible contributions as far as meeting requirements to put in. So there were foster care representatives who would get payments based on the difficulty of care for a particular child. That could be a special needs child or a variety of circumstances. Those payments are now eligible compensation for determining how much you are able to deduct or contribute to your IRA. So really just kind of more redefining of some more popular ways that we've seen income either be added or subtracted in recent years. And now there is also a $5,000 penalty-free distribution for birth or adoption costs. And that can be $10,000 total if the taxpayer and spouse both have their own individual IRAs. Spousal IRAs get set up a lot in the name of the spouse. So that's up to $10,000 free for birth or adoption, which I think is another great provision. There are a lot of penalty-free distribution reasons like higher education, significant medical expenses, and birth and adoption is now the latest among them from this act. So one of the key slides I would start if I had a printout or whatever, because this is very helpful not only for the assessment, but also a great summary of some of the stuff the Secure Act did. So some other changes is now that non-spousal beneficiaries. So if you're a beneficiary of a defined benefit, annuity, pension, or an IRA, you now have 10 years to fully distribute that account after the person whom you were the beneficiary for has passed away. It was 5, so now that's additional time before you have to dump the account out and pay tax on it. So that's just a small change there, as well as the changes regarding the multiple employer plans. That's more of, again, of a business provision. It's kind of outside the scope of this particular course. Not something you should be focused on right now. One of those moments in tax update where you're like, what the heck is going on? There's like 3 slides dedicated and you're like, I'm not following. So some other changes to retirement from the CARES Act. That was the Secure Act before we thought we were going to have a global pandemic. Now we have some changes after the CARES Act. And this is one that's been popular and people have heard about it on the news. Required minimum distributions have been waived for 2020, even for people that were scheduled to take their first RMD this year by April 1st. So RMDs already taken could have been rolled back into another account by August 31st, 20. That deadline has such passed. If you took it at this point and didn't roll it back into another retirement account like a traditional or Roth IRA, traditional IRA, Roth you'd still have to pay the tax on it, but a traditional IRA could have been rolled back into to avoid the tax. It's too late. You got to pay tax on it as if you took it this year to contribute. And this does not apply to defined benefit plans. So some pensions, annuities, you'll see them from public workers or a lot of plumbing union, anything with a union. You'll see some defined benefits. Those still have to be taken. That RMD is related to, I guess I didn't have a slide for it, is related mostly to 401ks, IRAs, your typical standard retirement accounts, just not defined benefits such as pensions, annuities, things like that. You can't shelter those yearly amounts. So I want to talk a little bit about coronavirus related distributions, so CRDs and loans, because it's another provision people are wary about, because there's not a lot of times that you'll get an opportunity to take money before you turn 59 and a half penalty free out of your 401k or your IRA, but the CARES Act presented an opportunity to do so. And the eligible individuals to do so, it's very specific criteria, are that you, an individual, a spouse, or a dependent has been diagnosed with COVID-19 from a CDC mandated test. It can't just be a piece of paper that says I have COVID-19. You have to have the test results. Are we going to have to fax those into the IRS? No, but that would be one of the stipulations that if you got struck by lightning and were subject to an audit, that would be, in order to determine the eligibility, that would have to be looked at. Other criteria includes people quarantined, laid off, or had reduced hours due to COVID-19. If you could not find childcare due to an operator being closed during COVID-19, or if you had reduced business hours due to state or federal mandates. We saw a lot of individuals or businesses closed down. What you guys hopefully are taking from this slide is it's a lot of people. There are a lot of people that fit this criteria, that they had a direct family member diagnosed with COVID, quarantined, laid off. Some of them may not have even needed to take money out of their retirement account to get by when dealing with these issues, but they have become eligible through this program. And I want to make that very clear, because you bet you'll be asked about it, especially if somebody took money out of their retirement account for a different reason, but meets the criteria. So these are the types of accounts you can take it. This is why I thought I had the slide, is because it's by the way, these are the same type of accounts with the required minimum distributions. These ones are, you no longer have to take an RMD out of. These are also the ones that are eligible for CRDs or coronavirus related distributions. It's IRAs, 401ks, 403bs, 457bs, and all those fun plans there. And once again, missing pension and annuity plans. So you can't really control the amount you're taking out there. So I guess that's kind of why it's left out of this exception. The amount limits are $100,000 across all eligible accounts. So if you took $20,000 out of your IRA and $80,000 out of your 401k, you could still exclude both. You're not subject to that standard federal withholding of 20%. You didn't have to do it if you were taking it out. You can actually incur a penalty if you take a large enough amount out and don't withhold 20% of your federal taxes. Those penalties or anything related to that do not apply in this circumstance. So some of the details, the penalties, like I mentioned, it's penalty free, even if you're under 59 and a half, and that'll be a kicker for a lot of folks. It will come out coded as a code 1, a normal distribution, and we will have to apply this code or this mandate to it on a Form 5329. We will have to say why the taxpayer is excluded. Normally doing that is something that is a little bit aggressive because you say it might apply to a first-time home buyer or anything like that. This year it's probably going to be pretty common because of this coronavirus-related distribution rule. The recontribution rules are interesting as far as helping clients plan, because if they want to avoid taxation of money that they used it in the very definition of what this program is for, so they used it to get by and now have got back on their feet and they want to put it back, you can recontribute funds to the same account within 3 years to avoid taxation or distribution. You can do this in full all at once or multiple partial contributions over the time. So you really have 3 years to put it back. And it's taxed evenly over the 3-year period, but you can opt out and pay all tax in 2020 if you'd like to. And I'm sure somebody's going to ask the question, what happens if you're taxing it evenly over 3 years and then you decide to put someone back? There's a form that the IRS will have you use that's a manual adjustment on that. I don't anticipate it'll be all too common, mostly because it is penalty free. And so a lot of people may choose to just leave it back out of their retirement account, but there is a form that you can reconcile how much should be taxed. And really what they do is they reduce the amount of tax that's being taken over the next periods of time. So if you split it up into 3 different periods and then you put some back, they look at how much is now remaining that should have been taxed, and then they lower your last two tax liabilities, or your final tax liability if you put it back in the 3rd and final year. And you can actually claim a refund tentative back to if you go back and actually amend the tax return. I'm not 100% on what the best protocol to do that will be. We'll probably have a lot more answers when the form is actually published for this. It's not out or published from the IRS yet. And yes, it is December, and yes, tax season starts in January. But we're still kind of learning and making it up as we go with these rules. But it's just something that people should know, because something tells me that we're going to get into a situation where a taxpayer took a hardship distribution. That's lingo we use for they took out of their IRA or 401k because they needed some money, but they actually fit the criteria. My wife had COVID-19. My son had COVID-19. My business hours got reduced, and all of a sudden then they become eligible for this penalty-free distribution, and it saves them that 10% in an additional penalty on pulling it out. So very important. We don't have a lot of opportunities to be creative and give clients advice about new tax laws. This is one of those, again, that I'd start. I actually don't know if it was very relevant on the assessment, but it's very, very relevant for actually doing taxes. So I'll get to questions here in 1 second because at the end of the section, but I do want to talk about their loans from the plan as well. Maybe some of you guys have personally taken a 401k or IRA loan. The maximum amount that you can take as a loan was increased federally from $50,000 to $100,000, and now payments are being delayed exactly 1 year from when the distribution is taken. So if you took a distribution in July and it was due for its first payment in November, that's now been pushed back out to November of next year, exactly 1 year from when the due date would be. But keep in mind, interest is continuing to accrue in that period. So some people might just start paying on it anyway. So this is my question slide, because then I put it in here in detail because I knew this section was going to be beefy. And so does anybody have any questions as I come back here? It's past 7 o'clock, so I want to make sure nobody fell asleep yet. I'm feeling like falling asleep myself, but any questions on the retirement stuff, because it's a lot of new changes for this year. We still on it? We do have a question in chat here. Blockworks has already included what changes? Greg, if you have a microphone, Greg, or you want to type in chat, which changes were you referring to there? That was 40 minutes ago.
So basically all the things you went over, they're going to be included in the Blockworks.
Oh, yeah, you bet. So what's awesome about Blockworks is it's actually rolling and it updates periodically, probably once a week or so, and they are continuing to tinker and add tax laws. This company goes next level for its clients in that sometimes if we see that we've submitted a Blockworks update and somebody may have already filed their tax return, and they've updated the tax laws and the forms to include the changes in Blockworks, we'll actually give them a call as managers and we'll let them know the situation to see if we can help them amend their return. So Blockworks is constantly evolving to the most modern tax law changes. I'd say if you have a tax form released or published, it's within Blockworks in 2 weeks. It's pretty excellent as far as keeping us up to date.
Okay, and then the one about unemployment, so they have additional income, so 50,000 plus 10,000 unemployment, and they're just going to be taxed additional 10% on the unemployment or 10% on their total income.
So it is so how the unemployment once again it just morphs into their AGI. And
Okay.
that morphs into their taxable income, which determines their tax bracket. So it kind of falls through just as if it doesn't even really have to be unemployment income. You could just think of it like another 10,000 in wages without tax withheld. It just trickles its way into taxable income and it generates a higher tax liability.
Oh, so they're not given a 10% penalty. Like, for instance, if you did it, so it's just an additional income, so there's a higher tax level at that additional income.
Yep.
Okay.
That's all that if we had people that were eligible to collect unemployment, they're probably not going to run into a situation where they're going to get penalized. It's called an estimated tax penalty. And that would be if I went out and I won a scratch ticket and I won $400,000 and I didn't send $1 to the IRS and all of a sudden my AGI came across 400,000 higher than it was last year. I would get penalized for not sending them enough of the tax I was anticipating to pay. Anybody with unemployment benefits is not going to have made enough from them that would make them eligible for that type of penalty.
Okay.
Okay?
Yep.
Perfect. You guys like my wreath that my mom put up behind me? It's tis the season, right? So I'll keep powering through. Good questions and really just very helpful tips that as you're sitting down, hopefully you just kind of remember that. And a lot of times you guys are going to turn to your mentor or your manager or somebody and ask, I have this situation and they weren't anticipating this tax. Really, the veterans are the ones that know these tax changes inside and out because they've been with the company for 30 years. They've got the fundamentals down. What's in the forefront of their mind are some of these changes. And so in some ways, they're going to be your best guidance on really remembering this stuff because you guys I call it a sponge, is kind of how much information you can take on at one point. All of your sponges are still full from ITC about really trying to get comfortable learning Blockworks and things like that. These changes aren't going to go into your sponge as easily as some others, but really, really cool stuff and some advice that I'm sure we're going to save clients a lot of money with at the desk this year. So I'll move into one of my not favorite sections. I had in my first year, I had a pretty bad mistake around a casualty loss, but I will hopefully try to prevent you guys from making any similar mistakes by learning through proximity because casualty losses are a lot different now than they were in my first year here. It's actually thankfully simplified, so you don't really have to worry about it a lot. It just doesn't happen very often. You have to be, I'll get into it with the situation that you need in order to qualify for special treatment, but we'll go through a little bit of the changes because this is pretty much it's a routine perennial section in this in the tax update because they talk about disaster changes every year. So can somebody tell me, by the way, what experience did you guys get with casualty losses in ITC? Was it any? Brave soul. Did you guys get any familiarity with casualty losses or any of the provisions around them? Because they're really not common enough, I don't think, to spend 72 hours in that. So did anybody feel like they've gotten experience in ITC or did they not really talk about it a lot? Baby.
I don't remember anything about it, so I think it was kind of glossed over in my class.
Yeah, no, that's important information for me to know because I want to start at ground zero then because a casualty loss, it used to be, so a casualty loss it can be as something as a non-disaster casualty, which is theft. If I had a $400 computer and somebody stole it from me, I could have historically reported that on my tax return as a loss and gotten credit for it on my tax return. It would have been something that had flowed through my my Schedule A deductions. It was something that I lost and I could take it as an itemized deduction. That really changed with the Tax Cuts and Jobs Act that went into effect really in 2018, because the definition of a casualty loss and what was eligible to deduct on your tax return dramatically changed. There really is only one type of specific casualty loss that you can deduct on your tax return now. You're kind of out of luck if you have a storm damage affect your roof and you lose your roof and your insurance company doesn't cover it. That's not really deductible anymore. My computer example is not deductible. A single home fire, if you don't have homeowners insurance or anything like that, that's not deductible. So it's not really something that you can take anymore. There's really one specific type of casualty that you can discuss, and I'll talk about it. It's called a qualified casualty, and it has all these special parameters around it. So the types of casualty losses, as I mentioned, are smaller ones like non-disaster casualties. You have federally declared casualties, and so these are damages related to federally declared disaster areas. And why this can be confusing is because that can be different than something that is a qualified casualty. And what that means is that these disasters have been specifically categorized by Congress as eligible casualty loss disasters. They have looked at the list and said, this is a situation that happened that has resulted in permissible casualty losses to deduct on your tax return. I know, it feels like micromanagement, but that's really what the Tax Cuts and Jobs Act did in general, is it made it a lot harder for people to take any sort of itemized deductions. And the tough part about this is it was last updated to include disasters through February 28th of 2020. So can anybody think of a wildfire or two that's happened since February 28th, 2020? Because I can. It affected one of my favorite spots in the entire state near Estes Park and Rocky Mountain National Park. That is technically not eligible to be declared any sort of property damage, in that is not eligible to be a qualified casualty because they haven't refreshed the list yet. And the type of disaster that you have changes the treatment when it comes to taxes. So really, in short, casualty losses, loss or damage of property or value that you normally would have been able to write off on your tax return. We'll talk about the one very specific example that still exists. And that is your they're called qualified disaster losses. And how it works is that you can deduct the entire amount of the loss that you suffered in a qualified disaster. So if you were in a qualified wildfire, if you're in a qualified hurricane area and you lost $20,000 worth of property, maybe it was like a boat or something like that, you can deduct all of that, except there is a $500 floor that you have to clear first. So they subtract whatever your total loss in value was minus 500. And why is that? So that, you know, it's like, well, my iPad got destroyed in a casualty. Well, it was worth $300 when it got destroyed. We don't want everybody that was affected by the casualty writing off less than $500, because this is a source of a lot of fraud. They really keep that $500 floor there to make it so that these are significant losses in value. If you clear that, so you're in a qualified disaster area, you're on the list that Congress makes, and you clear that $500 floor, you report that loss minus the $500 floor on Schedule A, line 16 under other deductions. However, this particular loss can be taken whether you take the standard deduction or not. So if you take the standard deduction, you can take your $12,000. This year it's $12,400. It's been $12,200. You guys know what I'm talking about. You can take your standard deduction as in addition to your casualty loss. Otherwise, if you're itemizing anyway, you just throw it under other deductions and it adds to your itemized deductions. So that's nice, right? You don't have to itemize in order to take this deduction. Very helpful. If a gain is incurred upon the purchase of replacement property, so you can occasionally receive a gain in that they replace your property, the insurance company does, and it has a higher basis than the property you lost, you can defer that gain by up to 4 years from the date of your new purchase. So if you realize a gain, you can have 4 years to prepare before you actually have to pay tax on it. And really what that means is that it might depreciate. You don't actually have a gain when you go to sell it. So you don't have to pay tax on that right away if you have a gain. Really rare to have somebody that has a type of property that steps up in basis like that. Most people, it's just an outright loss, no replacement. So does
Hey,
so
Austin,
yeah.
I don't think we're seeing your screen anymore. I think
Oh,
for
no.
some reason we might be seeing Greg's screen.
Oh, that's what it looks like. How's that? Did you guys see this slide here? How long
There
have
you
we
go.
been on
Yep.
Greg's screen?
Yep.
Hopefully Greg wasn't playing Candy Crush or something along the lines. So it's just so I spend some time here if you guys missed. Did you guys see this slide as well?
Yes.
Good. So I'll spend some time here again. Once again, it's just it's fairly simple to understand the tax terms of, because once you clear the $500 floor, you pull that out of the total deduction. It's the entire property. You can use it no matter what, and you can incur it, and you can defer a gain if one for whatever reason was incurred. So casualty loss is not hard, meeting the correct criteria. And by the way, putting that in practice, because if you take a casualty loss on property, it's almost a slam dunk for an audit or observation from the IRS, because they want to make sure you did it correctly, because it's just not something that a lot of people are qualified to take. It doesn't affect a lot of taxpayers at large. I don't even know if, like, Colorado residents, there are not a lot of them that would have had eligible criteria to be affected by a natural disaster. Certainly not us for Denver residents. We haven't had, thank goodness, a large escaping wildfire or any tornado damage or anything like that. So it's really not something that affects a lot of taxpayers. So here are some provisions around if you do have a qualified disaster loss. If you're in that qualified area by Congress, you can take loans and distributions from retirement accounts to help you replace property in those situations. And it's really identical for the loan procedures to the COVID-19 parameters we talked about earlier. It's now established at $100,000 max for 2020. You have a 1-year deferral of payment when your loan was made between 12/20/2019 or June 18th of 2020. So if you receive that loan on May 1st, 2020, you don't have to actually begin payment on that loan until May 1st, 2021, 1 year later, but keep in mind, interest is accruing in that period. The distributions are very similar as well, because you get up to $100,000 from a combination of different accounts penalty free. You can roll the money back into a different retirement account, an eligible retirement account. We know what those are by now. IRAs, a lot of employee plans are hard to roll into 401ks, but mostly traditional IRAs is what you'll see. You can roll that over to avoid taxation and delay it. It's really the same as the COVID parameters, where you can spread it evenly over 3 years or make all of the tax liability happen in the first year. You're not subject to the 20% withholding requirement. And really the important stipulation, if you do run into one of these, is that you can use your prior year AGI to determine your amounts of earned income credit and additional child tax credit. And why that might be helpful is because if you take $80,000 out of your retirement account to replace property, that can significantly raise your AGI in the current tax year, and it can make you ineligible for tax credits that you otherwise would be eligible for. And that's why the IRS recognizes that and lets this one special provision use last year's AGI. You have to identify on Form 8915 that you're doing that, but it helps you calculate your credit amounts, what they should have been had you not had that unexpected disaster boost in income. I wish there were more of those provisions, so that if maybe you got a one-time exception from that, because it heavily contributes sometimes to that refund surprise thing I was talking about earlier. But it is a provision here for your qualified disaster losses. So like I said, and I highlighted it because it's super important, disasters after February 18, 2020 are not subject to the preferential treatment of qualified disasters until the list is updated. That's a hint when it comes to taking an exam later. That's not the question verbatim, but you guys can figure it out from there. It becomes a loss of personal use. If it's a loss of personal use property, you're subject to a different floor than business use property. So you're subject to 100%, $100 floor, as well as a 10% of AGI floor. So what that means is that it has to be at least over $100, and it has to be at least 10% of your AGI, and then you can begin to take the deduction that is in excess of 10% of your adjusted gross income. In short, what you need to know from that is personal use property, very hard to deduct. But What it can do is it can offset a potential unrealized gain you have on other disaster property. So if you got a replacement home, it significantly increased the basis in your home, you can use personal use property that otherwise wouldn't have met that criteria earlier. You can certainly use that to offset the gain on other disaster property. That's a little bit confusing. I don't want you guys to get too hung up on that because it doesn't happen very often, but just know that personal use property, things like iPads and all sorts of stuff that really would never, for most people, meet the 10% of AGI floor, because if somebody makes $30,000 a year, 10% of their AGI is $3,000 that you have to clear before you can even begin to take personal use property. Losses must be reported in the current year as well, or the preceding year. So that's the year the tax return is filed. I think I have the wrong terminology there. That should be preceding, not proceeding. And that prevents people from waiting for the disaster list to update for preferential treatment. If you can't just simply wait in line until Congress gets your disaster squared away and then take your money, because then I suppose it's a weird stipulation, but they don't want people to wait for the tax laws to become advantageous to plan taking out of your retirement account. And so where this leads us is something called a net operating loss. And I know this wasn't covered in ITC, and because it's a little strange to think of it this way, but deductible casualty losses like these ones we're talking about from disasters, they're actually considered business expenses. And that may be strange if you're somebody like, well, I have a Schedule C, so not me, but if you're somebody like Trevor who just works on a W-2 and to my best of my knowledge doesn't do anything else on the side, he's still eligible. He would still be eligible to take a potential casualty loss on his business expenses. And what that means is that it could result in a net operating loss that actually can reduce his taxable income this year, and it could carry forward into future years. And there's been plenty of rule changes around this, as I'm sure you'd imagine, because of the Tax Cuts and Jobs Act and the CARES Act. I think there's 7 slides dedicated to the net operating loss changes, because it starts with what the Tax Cuts and Jobs Act put into effect, and then it moves and proceeds forward into what the CARES Act changed. So this is what I want everybody to know, because this is what's important. These are the rules after the CARES Act and the Coronavirus Relief Act. The net operating losses are now to be carried back 5 years from the year they were incurred, and then forward indefinitely. Okay, that is not the way the rule has always been written. It has been changed several times, but that is now the procedure for net operating losses, is that they are carried back 5 years. So if somebody generates a net operating loss in 2020, that gets carried back to their 2015 return by default. You can't stop anywhere along the way. You carry that loss back to 2015, and you begin to offset income from 2015. Why do we start in 2015? Because what if you have another net operating loss in 2021? Then you start in 16 and then move forward to where you have income. If you're a normal taxpayer, I'm almost certain that your net operating loss is going to be at least consumed in the first couple of years, because you should have a general profit from your W-2 and your wages that it can offset. If you'd like, though, you can attach a signed statement to your 2020 return to waive that 5-year carryback provision. You can say, I would not like to do that with my 2020 net operating loss. I'd like to carry it forward. You have to have a signed statement on your tax return if you choose that. So it's kind of an opt-in to waiving the carryback. Otherwise, the default is it will be carried back 5 years, and that is where the net operating loss is to be applied first. If you try to carry it forward and you didn't attach a signed statement, you best bet you're going to be hearing from the IRS because you didn't follow the current net operating loss rules. This is somewhat confusing. You'll file the 1040X within 3 years. You'll file an amendment because up to this point through the CARES Act, you were not able to carry losses back. That's brand new as part of this coronavirus relief effort. So now people will be coming in to amend net operating losses for 2017, 2018, and 2019 that are still eligible for amendment. That provision will now carry those net operating losses back. That's not something you guys are going to have to worry about. But this is just a general rule, is that we take that net operating loss back 5 years and then forward indefinitely until we offset the entire amount through the income provided in those years. So that's just the default rules you should know. You probably won't get a lot of hands-on experience with them. I think I've done nearly 900 tax returns in my career at H&R Block. I think I may have seen 2 net operating losses. So not something incredibly relevant, but maybe so if you're trying to work through the exam. So does anyone have any questions on that section that's a little more difficult when it comes to a lot of business concepts in there and stuff you've seen for the first time? Awkward silence. Okay, so I'll move forward here. I want to get moving. I didn't want to take all 3 hours of the curriculum, so try to be respectful of everybody's time. I promise that section 6 and 7 are very, very tiny. So this is
not
really
right now.
Yeah, this is really the last lengthy one. So I want to talk about some exclusions, deductions, and credit changes. That kind of starts in this module with the qualified principal residence indebtedness rules. That basically what those rules were reinstated to do is that it's exclusion of a specific type of solution related to avoid foreclosure on taxpayers' main residences. You can qualify for this PRI, principal residence indebted treatment. That will exclude that income from gross income if this foreclosure has happened anywhere between January 1st, 2007, and now it runs through December 31st, 2020. This had not been picked up and revised. It has been for this year, and now all of these solutions related to that cancellation qualify for this treatment. You fill out a Form 982 to do it, and like I said, it's through the next year. There are 3 categories that can qualify for this type of exclusion. It is the QPRI treatment, as well as general insolvency and bankruptcy. You have to move in that order. So if you are first eligible for the QPRI treatment, you cannot use the insolvency exclusion unless you apply for it. I don't know. I really have no idea why somebody would do that, but that's just a specific rule that the IRS has put out there for me to tell you. So something else that's changed in 2020 is there's something called private mortgage insurance that somebody can purchase. This is once again deductible on your Schedule A, and somebody can choose to purchase private mortgage insurance in case their home were to be foreclosed upon. That I suppose they pay a monthly fee, and it can be provided by any of these organizations to qualify for the deduction on the Schedule A. It's just a general itemized deduction. Department of Veteran Affairs, the Rural Housing Service, the Federal Housing Administration, or private mortgage insurance companies. So you can purchase this in a lot of different ways. It's like a additional add-on type of thing when you sign and close on your mortgage. It is deductible and it will be reported on Form 1098 properly. So some charity changes, because we saw the change on the first form that was a little interesting. And so another change is that the charitable contributions are now limited to 60% of your AGI. That it's an exception here for 2020 that there is no limit if providing if given to a 50% limit organization providing 2018 or 2019 disaster relief efforts. So that's basically anything that's on the qualified list. There is no limit as far as AGI is concerned to the charity contributions. My goal in life would be to be somebody that has to worry about how much of their AGI they're contributing to charity. That means that you're not making very much income right away and you're donating a lot of it to charity. So an exception there around charitable contributions. And then really the big one that affects a lot of our clients and a lot of us is above the line deductions. As you can probably guess, this isn't like your normal charity contribution deductions because it is cash only. And if I were you guys as tax preparers, I plan on doing this. If I write a tax return, it's cash only, and I want to see those receipts because almost every organization that qualifies as one of these 50% limit organizations, they know we need receipts and they send thank you letters and receipts throughout the year, and even churches in a lot of places are doing like that. This does not have to be to a COVID-19 related charity relief effort. The incentive behind it was due to COVID-19 relief efforts, but it doesn't have to be. And that's really just $300 as a cash contribution that people can begin to take. And this is especially helpful because after the Tax Cuts and Jobs Act, we saw a significant reduction in the number of people that actually itemize their tax return anymore. Now this $300 is available for people that have given throughout I like that because a lot of people think it's deductible and then they end up not being able to take it. They get sad. Now they'll at least be able to take 300 of cash contributions.
Austin, is the 300 a max?
Is the 300 a max?
Yes.
That is the maximum that you take as an above the line deduction. You can take the remaining amount on the Schedule A.
So,
And that's
so a letter of a deduction or a donation of $250 to a qualifying would just be a $250 deduction, correct?
Yep, and it would be above the line on that on the first page of the 1040, like we saw at the very beginning. That's where it will be reported as $250 there. If you go over $300 in cash contributions, like I said, then we're going back to the Schedule A, and just like it says in point 1, it's limited to 60% of your AGI as the total charity contributions you can take. And that can be cash or, as everybody knows, it's property as well. It can be like home goods and things donated to organizations. That stuff can still be taken on Schedule A. With the above the line deduction, cash only. Okay? Perfect.
So I have a question also. If
Yes, sir.
someone is, it doesn't like, it need like to make a charitable contribution, like maybe 4,000 something.
Okay.
If he take like standard deduction, it doesn't make sense for him? Yeah, is that like that?
I think you're interpreting it correctly. Where he could take the maximum of 300 above the line. The remaining $3,700 of that gift would then be transferred to his Schedule A. And if it makes sense for that person to itemize, now you think of a situation like you're saying, maybe they don't own a home and therefore they don't pay any mortgage interest, they don't pay any property taxes. Going to be really hard for them to itemize and take advantage of the rest of it.
Yeah.
But before this change, they were totally out of luck, and now at least you get the $300 above the line. So a little bit of a bonus there, but yes, you're 100% correct, and that's good that I hear you understanding that, because that's exactly how it works. So I like this is like a tug of war thing, I guess. I really can't. I can't wrap my mind around who's actually going back and forth on this, but the medical expense, there's a floor before you can begin taking medical expenses on your tax return. And the reason why is because it is a very difficult thing to audit, and they want to discourage people that don't have bona fide large out-of-pocket expenses. And that comes from individuals without health insurance paying for out-of-pocket procedures. Those are very easy to track and trace. What they don't want is they don't want your client in her 80s that's retired who grabs all of her receipts from CVS and makes sure to highlight every little thing that counts as a qualified medical expenses, and she takes that $300 every year through 40 different receipts. They want to discourage that type of medical expense deduction because it's just much harder to trace. There is a floor, therefore, on it of you have to be above 10% of your AGI before you can begin to take medical deductions. In 2020, that has reverted to what it was a long-standing rate of just 7.5%. The TCJA raised it to 10%. It is back to 7.5%. So like I said, tug of war, what you now need to know is that 7.5% of your medical expenses is the amount you have to clear before you can begin taking them. And a good example of that is if I have my AGI is $100,000, I have to have more than 7,500 or 7.5% of my AGI before I can begin taking my medical expenses. Okay, that's no different than what you guys probably learned in ITC, but the rate has once again changed, and Blockworks will do that for you, but it's something you want to be aware of at what's happening on the tax return. So I'm surprised I made it this far without diving into the economic stimulus payments. The recovery rebate credit, it's $1,200 per eligible taxpayer, $2,400 for married filing joint returns, and then gets an additional $500 per qualifying child. Guys, you could probably guess this wasn't rolled out very well, and it was, believe it or not, it was harder than you think to get $1,200 in the hands of every single American and do it in a way that made logical sense and do it fairly quickly. This was an advanceable, meaning that it was paid out in advance, refundable tax credit, and so it actually shows up and rears its ugly head on the tax return in 2020. Taxpayers with a higher income may not qualify or may be eligible for a reduced credit. It is reduced for 5% of the taxpayer's AGI that exceeds the threshold. So if you made under $75,000 as somebody who is single, a qualifying widow, or married filing separately, you receive the full $1,200. If you made under $150,000 as a married filing jointly couple, you received the full $2,400 because they just paid you both at once because it was a married filing joint return. A lot of it was sent by direct deposit. If you are a head of household filer under $112,500, you received the $1,200 payment. So you guys can see a lot of people ended up receiving this payment, and very few of them actually need adjustments anymore because they received the $1,200. That's what they were supposed to get. That's all they got. They're good. Do not have to pay anything back. Don't have to report anything on the tax return. Done. These taxpayers were not eligible taxpayers. Non-resident aliens filing their tax return, people who were claimed as dependents of another taxpayer, and you best believe that I've spent plenty of time on the phone with this one because the box on the tax return reads, is eligible to be claimed as checked as a dependent. Blockworks fills that in for us if we answer the questions the correct way. We don't get to choose whether or not that box is checked. We only choose whether or not the child is claimed. And that's just depending on how we answer their criteria questions. What that led to is we had some dependents that came and filed with H&R Block, and their box was checked. They didn't get their stimulus. They were very angry. Understandably so. I'll get to in a minute how we're going to make it better for them in 2020. Estates and trusts also didn't get it, as well as taxpayers without a social security number. That's somebody operating off an ITIN. Those guys were not eligible for the economic stimulus payment. The qualifying child, you get $500 per qualifying child that is eligible for the child tax credit. It's the exact same criteria as the tax return. And so this is explaining the $1,200. So the program is mostly over in practice, like I said. The deadline for non-filers is a little bit of background noise.
You don't see all those other bills.
I'm going to go ahead. I'm going to mute all participants here, and you'll have to unmute if you want to participate again, okay? I got a little bit of background noise. I want to make sure everybody can hear. So, got to share it back in the PowerPoint. There we go. So this like I said, this program is mostly over in practice, and the deadline for non-filers to use the tool that the IRS provided was on October 15th, 2020. So the extension filing deadline, it is listed still available for claiming through December 31st, 2020, but that is mostly them processing individual claims at this point. So somebody is manually calling the IRS and said, I didn't get my advance payment and I want it. The automatic sending of the payments is over. The deadline for the tool was October 15th. This $1,200 was not subject to an offset, meaning past due child support, student loans, and other funds. That is the reason why some people lose out on their tax refund. It was not eligible to offset this $1,200. It was sent to every American that qualified for it and was in the program. If people did not file a tax return, there is some confusion about this, but these were the steps to take. They could either come into H&R Block, and we actually did this for free for our clients, and they could file a simple tax return. It was actually blank. We sent it for electronic file. Or they can use the IRS non-filer tool. I'll give you guys a hint. It did the exact same thing. It just filled in a tax return for them that was blank. You can add dependents on there if necessary, and that helped them with the $500 addition. And what it did is it filed a simple return that produced their eligibility for the stimulus check. If they actually ended up needing to file a return after that, they'll have to use an amended tax return to change it. If they try to send another one via e-file, it'll get rejected, and they'll say, why'd my return get rejected? Well, you already went ahead and used the non-filer tool to get your stimulus. Now we got to change your tax return, and how we do that is by basically amending a blank tax return. So that's how you affect it on record if they've already gone through and used the tool. This is a very important thing to memorize. So another one of those star slides. If reconciling the credit, if not enough credit amount was received in advance, you could reconcile it on Form 1040, page 2. And where this will most likely come into play that we'll see the most is people that were claimed as dependents in 2019 and didn't get sent their payment. they can now go ahead and not claim themselves as claimable in 2020, and they can claim the entire $1,200 on their tax return this year, get a nice little bonus. So that's awesome. That's the next best way to do it. They'll get their funds after all. They'll be happy. You can also claim if you were missing $500 per dependent, as many people were. That extra $500 per qualifying child, if you meet the criteria on either your 2019 or 2020 return, can be used here. So if you're missing a $500 per dependent, some people might claim an additional $1,000. The credit is refundable, meaning it ends up in their pocket. But what's most important on this slide is if they receive too much credit, no repayment is required. If they made a mistake in AGI, if there was an error in dependent logistics, as in somebody claimed 2 kids and they were sent $500 per kids, but actually one of them should have been eligible but claimed by a divorced parent, blah, you know how messy some of that stuff can get. If there is an error there, the person does not have to repay the advance credit. Or so they're good to go. Okay, they're not going to hunt people down for the extra $500. So they've made this very simple for us to reconcile, I'd say, correct? So very, very nice of them. So moving away from the stimulus stuff here, well, I'll get questions at the end. And once again, you'll have to unmute because I muted some background noise. So you'll have to unmute if you do want to pop in with a question. The non-business energy credit is back. And it's one of those things like the tuition and fees deduction that went away. And now all of a sudden it's back in something you can use again. So if you wanted to use it for 2018, 2019, or 2020, which is the upcoming year we're going to file here, you can amend for prior years, or you could just file it if it was one you would have used in 2020. And what it is it's a 10% credit on all improvement property that qualifies with a lifetime maximum of $500. So it's not very big. It's not something you can use every time you put in new doors or new windows or new siding or insulation or anything like that. It is a one-time credit you can take for some large expenses, but it's a lifetime maximum of $500. So some of the improvements I put on here, just so you guys do get an idea of what they are, it's insulation, doors, windows, sidings, metal roofs, qualified water heaters, and natural gas appliances. How this credit works, by the way, is I use the word lifetime there very specific because if you put in a brand new set of windows, and I may come off really out of touch here because I've never owned a home, so I've never put windows in them. The $3,000 that you spend to put windows in, even if it's just a couple rooms, I actually don't know how much windows cost, but the 10% of that $3,000 would only be $300, which means you have $200 additional dollars that you can use toward another non-business energy credit eligible property. In your people, whoever you're putting the service in through, or if you're doing it yourself, largely there will be explanation that it can qualify for this tax form. If you guys get the idea, if it is like energy efficient insulation, doors, windows, siding, almost anything you can provide through a major retailer nowadays qualifies for this credit. You can go ahead and claim it on Form 5695. And it's a lifetime maximum. You can use it in multiple years, but once you've used all 500, you're out of luck unless the lifetime maximum changes. Some vehicle credits were also extended through 2020. There's not a lot of them that apply to our taxpayers, and this is a point of confusion because every year we'll get taxpayers that come in and say, I bought a Tesla, where's my tax credit? Well, that's not an eligible tax credit for personal individuals because these are the 3 that still exist. There's a fuel cell motor vehicle credit where you can get between $4,000 and $40,000 on qualified hydrogen fuel cell vehicles purchased. This is the only personal use property credit that exists. So I want to make that very clear is that this does not have to be a business use vehicle to be eligible for the fuel cell motor vehicle credit. My search history looks like a crazy person because I wanted to confirm that. That's what the training seemed like. And from all sources I could find, that's true, is that this is the one remaining personal vehicle credit that somebody can fill out an eligible form for. There's also the 2-wheeled plug-in vehicle credit, but this is limited to businesses only. These are business vehicles, not personal ones. So somebody who's self-employed, somebody who has a partnership or a corporation, they can take 10% of the vehicle cost on electric motorcycles with a maximum credit of $2,500. The alternative fuel vehicle refueling property credit is a business credit again on an alternative fuel source vehicle property. So that again is related to like electrical cars like Tesla, but it's not personal use. It's business use only. And so you can absolutely qualify for that credit. The course detail didn't actually break down any sort of maximums. I actually don't believe there is one. You can't use it on property that is subject to depreciation. There's no limit on depreciable property. So it works like so in that when you're depreciating the property, however much it costs up at front, you are depreciating that over time, but you get a credit for the purchase price as well. It's business only though, so we don't see it particularly often. I don't want to spend a lot of time on vehicle credits because I've never filled one out for this reason. You don't see hydrogen fuel cell cars a lot, so it doesn't really apply to a lot of taxpayers. I want to talk about this program too. I'm almost wondering why it's not in the identity theft section, because the IRS has expanded this IP PIN program, which is it's like a double-edged sword in that it really does conquer a lot of good, but it also can really hinder us sometimes in that they assign an at-risk taxpayer a 6-digit PIN necessary before they can electronically file a tax return. The difficulty behind this is until 2019, this PIN was only available by mail. And if somebody was not able to receive their IP PIN, their return would get rejected. If they could not find the letter by mail, we had to paper file. We had no other options. But now these PINs are available for clients to find for themselves. They're available and accessible on irs.gov. That is a gigantic improvement for us in our business flow. I've had clients go ahead, retrieve the PIN within an hour, and get it back to me so we can electronically file their return. Colorado and many others are participating states. The coursework had all of them listed out. I didn't want to list all 20-something out here, but there's you can voluntarily enroll in this program if you feel like you want to protect your security. But once you are in, you are in. You will need a 6-digit PIN the rest of your life before you can electronically file a tax return. It is good, and it's equal parts good and bad. I think it helps now that you can get it online because they could not even verify you downtown at 19th and Broadway at our local IRS office. They were not able to verify that and give you your IP PIN. Yeah, it's a very strange procedure in how that IP PIN program works. Now it's eligible so people can retrieve that offline. So very helpful, and the program is expanding, and it's helpful if people have been the victim of identity theft to make sure it doesn't happen again. So I talked about this a little bit earlier. The coursework dives into some of the due diligence behind uncovering clients who might have this. This question is absolutely going to be asked on the first page of the personal info section of Blockworks. At any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in virtual currency? That question is either going to be yes or it's going to be no. Well, I'll have to scramble like mad to find somebody that I do have a few virtual currency experts throughout the district here, but it's not something you see incredibly often. So does anybody have questions on section 5 before I can fly through section 6 and 7? We hanging in there? Cool. Let me check chat here, make sure I didn't miss any text questions again. Perfect. So let me keep moving here. Oh, it doesn't look like my screen. Oh. As I fumble around with this now. There we go. Okay, so we'll talk a little bit. There's not really a lot of new content in here. Just some general stuff that you guys probably learned throughout ITC too, but there are some different hot topics that the IRS is monitoring, and as you might imagine, it's coronavirus-related scams and identity theft behind coronavirus-related material, like, you know, fake participant vaccine programs, like all sorts of awful malicious stuff that's been out there as far as people collecting identity and information from, as all of those sources are a lot of fear and lack of knowledge around the subject. So the IRS is monitoring those heavily about any for-profit scams or anything like that. Any fraudulent unemployment claims to take advantage of that bonus unemployment we took of earlier. I have to imagine that as somebody somewhere in the district might run into someone getting an unexpected unemployment benefit, and what that means is that person might have been the victim of identity theft because somebody said, I have this person's information, I'll just apply for unemployment. They're letting everybody have it right now. I can put in the $600, get the $600 bonus a month and make out scot-free. So some really unfortunate unemployment claims that they're taking advantage of there, as well as that $1,200 theft. Somebody that filled out the non-filer tools in someone else's name. That requires another typo. Form 14039, which is identity theft affidavit. If the taxpayer is believed to be affected, that's one of the first steps, is filing with the IRS that should feel like that you might be on the wrong end of somebody filing with your filing. That's technically a tax return with the IRS, and so a lot of problems associated if somebody were to unfortunately do that. That's it. That's literally all of Section 6. There is, if you go back into the curriculum, there is a dirty dozen list of things that the IRS is looking at, like fake charity scams and things like that, but it's not particularly difficult or new. So I kind of left it out of my curriculum, but you're more than welcome to dive back in if you want to read through all 12 in detail. So I didn't want to allocate a lot of time for it because I know we were going to spend a lot of time on the meat and potatoes and not necessarily the little parsley on the side. So if you have any questions, you can let me know about that guy too. So I'm going to fly through Section 7 here because it's a lot of stuff that, like I said, not only Blockworks controls for you, but I don't really have it memorized myself because it changes every single year. And this is exactly why. It's adjustments related to inflation. As our currency inflates, as general society and GDP moves up, every year the standard deduction and things around that raise or change as a result. And so you can see the difference. The way to read these charts that are coming up is 2019 is over here on the left side. The brand new provisions for 2020 are on the right side. And what you'll see in a lot of cases is they've gone up $200 per person just as they did last year. So the single under 65 standard deduction was $12,200. Now it's $12,400. And you guys can see the ripple effect through a lot of these. It's up $300 for head of household. That's both over and under 65. The qualified widower up $400. That's both over and under 65. So you can see the trend is the adjustments for the filing requirements. Like I said, please, whatever you're doing right now, don't pull out a piece of paper and try to write all this information down because it's not only in the curriculum, it's also in the deck I sent out earlier. Here's your gross income test for somebody who is a qualifying relative. Remember, you have to earn a certain amount less than, but for that person to still be eligible as a qualifying relative, bumps up $100 in 2020. We've got new standard deductions. Hint, they very closely resemble the filing requirements for a reason. And then they factor in if you're over 65 or blind as well. Each, so if you're over 65 and blind, you add $1,650 each to the standard deduction. So they feel very similar. It is because a lot of them are the base filing requirements. You have the 65 and blind add-ons. Here are your new tax tables. Couldn't tell you what the 2019 ones looked like, but those are, I put them in the deck just so you guys have them because I don't know if you'll get a random question on the assessment about how much tax is assessed if you made in 2020. Well, this is where you'd come to calculate tax, just as you guys did in your class with manual tax liabilities by using the table. You look at if they're between 40,000 and 125 and 85.25, you take this flat amount times 22% of the amount over the difference. So tax table is not particularly interesting or relevant in 2020 with the computers that do it in split seconds. Some credit thresholds here. A lot of these guys haven't changed. You got earned income credit threshold related to the additional child tax credit. You're still eligible for it as long as you're under the $2,500 limiter. Maximum amounts exact same as last year, the $1,400. I'm going to flip through these fairly quickly as I sent them out to ones that might be relevant. This one stayed the exact same. I think that's very common. We see the child tax credit is still $2,000 per child. The phase outs are now $400,000 for joint filers and $200,000 for all other filers. I don't know if that's any different actually or not. My guess is it is unchanged, but once again, a lot of stipulations and rules in here. Earned income credit thresholds. This is if you have no children here at the top. if you're single, no children, can't earn more than $15,820. I know that was boosted up. It is boosted every year, as well as these guys get boosted up as well. So if you have a qualifying child, can't make any more than 41,756, and you can see it escalate as you have 3 or more qualifying children. So the earned income credit thresholds absolutely change every year. The let's see what we got here. No changes to this other dependent credit. That's if they're over 17. We see this with college age children. You've got the $500 per qualifying dependent that isn't a qualifying child. You see that a lot. Totally unchanged there. Don't believe lifetime learning's changed at all. Even the phase outs here. You can see very low phase outs for lifetime learning. You can't take it if you're over 69,000 and single. And then here are your retirement savers credits. If you earn, so you say you're single down here and you earn less than $19,500, you get to take 50% of whatever you put away into a 401k, IRA, whatever you might have. Most often I see my clients right here in the AGI range between 10% that they're putting away for retirement. They get 10% of whatever they put away as a retirement savings credit. You guys are feeling good now because you're like, yeah, I know these credits. I took ITC. I remember all this stuff. And then a couple of residential energy credits as well. The 30% for qualifying solar panels, that's the ones you see most often here in Colorado, but occasionally you will see like small wind energy projects and things like that. 30% of all qualifying expenditures. I actually got to do this one in August. I had a lady come in and she had solar panels installed in 2019, doing her return a little late. And then this non-business energy credit that we talked about earlier, so lifetime 500 maximum for that guy. The IRA contribution, I actually don't think really any substantial changes here. Contribution limit being $6,000 or $7,000 if you're over $50 or 50 years old. Sorry. And catch-up contributions if you increased from, oh yeah, here's your change. Okay. Catch-up contributions for Roth were changed from $6,500 to $7,000. So that's on Roth IRAs. The traditional here not changing. That was the 6,000 7,000 split, and that's really the more relevant one for a tax return because this is your one that you'll see here as far as affecting your deductions. But it's good to know for clients that they have a maximum contribution limit of their taxable compensation or whichever one this might be, as well as you've got phase out ranges for how much you can actually contribute based on your AGI. So those are available to you. The every year Medicare Part B, the contribution default will change. It increases the higher your income is. And this is one of those things like I talked about with the disaster property. This is a ripple effect because it's based on your tax, your AGI on your tax return. If you report over 87,000 in income because of like a sale of property or one of those disaster distributions, it'll actually change how much you pay for Medicare. So kind of important to note that if your clients are retired and collecting Social Security and paying to Medicare, you know, what you're doing on the tax return does kind of ripple back to them in some ways. Sometimes it is just because they did sell their property, and it is, you can submit a manual adjustment if you choose to. That's an advanced process. I wouldn't see that very often, but something I want you to note there is that they did bump it up to $144.60 for what people take out of Medicare each month. Of their Social Security for Medicare each month. And then the Social Security ceiling is up to $137,700. And again, what I refer to as the ceiling there is that is the maximum amount somebody can be taxed on their wages related to Social Security. Anything earned over $137,700 is not subject to Social Security. And you've got your max earnings here when you're collecting Social Security, $18,240 if you're not retirement age. That's mostly we see people on disability through Social Security. This is their maximum that they can earn. That's actually up a couple $1,000s from last year, and then $48,600 if you've already met retirement age. That's the maximum you can earn and still collect. So, these are some other miscellaneous adjustments. Hint, hint. For they might be helpful later. I'll leave it at that. But the HSA contribution limits this year, those did change a little bit. It's $3,550 for yourself, or another $1,000 if you're over 55 is kind of a catch up. You can contribute $7,100 if you're a part of a family plan. Again, $1,000 extra of a catch-up. The mileage rates for 2021, I think these are the exact same. 57.5 cents for a business mile, 17 cents for medical and moving is the same, and then 14 cents for charitable mileage when it comes to configuring your deduction for how much you drove in your car. The Section 179 deduction for businesses, and what that means is the amount of property that they can depreciate right away because of a special exception in Section 179. Businesses have a maximum of, it's 2 years ago, it started at $1 million, and that was a gigantic jump. This year they've been raising it 20,000 each. So now 2 years later, it is $1,040,000 is the maximum amount businesses can take in property right away. Don't have to subject it to depreciation. It is taken right away. And then your 401k contribution limits. This is up actually $1,000 from last year, $19,500 if you're under 50 and $28,000 if you're over 50. That is your bonus as a catch up. If you're over 50 years old, it's $28,000 is the max you contribute to a 401k.
I have a question.
You bet. Right screen for it.
Prorated in the year that you turn 50, or the whole year that you're 50 will go up to 28,000?
So it's classified as under 50 or 50 to 60.
If you turn 50 during 2020, then your limit for the year is 28,000.
That's a great question. That's a great question, and I would assume it is how it holds for the entire IRS procedure, in that it is whatever your date, your age was on the final day of the tax year.
Great.
So whatever your age was on December 31st, 2020 is how old you were when configuring those limits.
Awesome. Thank you.
Okay, cool. I thought you had stumped me. The ESPN used to have this really awful show a few years ago called like Stump the Schwab on sports trivia knowledge. I think you got me there for a second. Now I just had to think through it.
You have all the answers. They're all in there.
Yeah. So does anybody have any other final questions or just a general discussion? Do you guys feel, some of you, it sounded like had already gone through the material. I hope that was helpful, because my idea behind this is I wanted to bring it to life and not force you into a painful self-study where you didn't really understand some of the material being thrown at you because you don't have a lot of experience with businesses or with casualty losses. I kind of wanted to bring it to life a little, even though I'm not a certified instructor, and kind of help you guys along.
It was awesome, Austin. Thank you so much.
Good. I'm glad to hear. Yeah, I'm glad to hear you guys did well. And I posted my contact info, and I will do it again, because guys, as you are working toward, you'll find this is a company of milestones. And so they want you to get done with, if you get done with your tax update, then you get that out of the way, then you move toward your other stuff. I want you guys to, as soon as you can, proceed forward to the assessment. And my email box, you can ask Luna, you can ask anyone that's interacted with me before. It is wide open for questions. As far as if you want to cut and paste a question in there, I'm not going to give you the answer, but we can walk through it. I can point you to the exact spot in the curriculum it is, since I went through it. I'm here to help you get through your tax update. It's a very, very straightforward thing for me to help. And I don't want you to get so frustrated that you're like, gosh, why can't I just get through this test? Or I don't understand this question, or this wasn't part of Austin's deck. I want to be here and a resource to everybody. Okay. So,
Austin,
yeah.
a quick question. When we had our orientation last week, I think a couple of us had asked about the ability to add tax update into our transcript, and I'm one of those who I haven't taken my final yet from ITC. It's next week. So yeah. I believe I can't add tax update or take the final or take the test for tax update until I finish ITC. Is that right?
That's exactly right. We did. I'm sorry that hadn't been communicated to you, but we got an answer the very next day. We got that as soon as you finish ITC, your final is in, it's graded, you're done. You then become eligible to add tax update free of charge. Please let me know immediately if you guys have you jumped the shark and you paid $35 for the course, because I don't want you to do that. It's not. It's one of those things where I probably would just ask Block Academy for a manual exception for next year's fee, because come January, myself and all of us as tax pros, we will have to pay our yearly library access fee again. I don't want you to pay on December what is it? Yeah, I think it's like 10 days to Christmas. Like, I don't want you to pay for 15 days for $35 and then have to turn around and pay right again in January because you certainly didn't get your money's worth. So we'd look at turning around a manual exception, but please, 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 please do not access that before you finish your ITC final because everything is supposed to happen in a particular way for a reason. Okay?
Okay.
Perfect.
Thank you.
You bet.
Thanks, Austin.
Any other questions? You guys are welcome to hop off, and if I don't have any other questions, I'll sign off as well. I thought it was a great deal of fun, and I am always available for questions. Okay.
I appreciate
Thank
it.
you so much, Austin.
Everybody
Thanks,
have a
Austin.
wonderful
Have a great
evening.
night.
Okay, thank you very much.
We will cross
Thank
paths again.
you.
I'm sure. Bye.
Bye-bye. Good night. Good night, everyone. Bye-bye.
Thank you. Bye.
Austin, are you still there? Okay, no, it's not.